what's up all of you beautiful people? I'm Jack Chappell, and today we're going to be talking about should you buy high dividend stocks. That's what we're going to be talking about today. So let's get right into this now. So first of all, if you don't know, what are dividends? Okay, so dividends they're pretty much cash, but let me explain what happens. So if you don't know what dividends are when you invest in a company. So let's say you invested in a company like, let's take Microsoft, okay? So you invest in Microsoft, their stock price is, let's just say $100 flat. If they were to pay a 1% annual dividend, that would mean that they would give you cash into your investing account of $1. $1 per year. So getting into this here, so $100 stock at 1%. It equates to $1 per year. So that's a decent way of explaining what dividends are. So this is when a company, usually a profitable company, they decide to reward their shareholders for investing in their stock. This is a common practice for especially older companies and companies that are in a high profit margin industry. And so those are really the two ones. And I guess if you're an older company, yeah, so older company, a high profit margin, and have a lot of cash in the bank too, that's another thing. Those are usually the types of companies that pay out dividends. So why is this important? Why are dividends important? Well, it's because it's almost a guaranteed return on your investment. And it's cash. You get cash, like actual cash in your account from just holding onto a stock. So a lot of companies out there, now we're going to get into the high dividend stock part right now. So let's start off at most companies that are tech or speculative, startups, companies that are losing money. They usually do not pay dividends at all. That is because, well, they need the money. They need the money, and they think that they could do more with their free cash in terms of growing their company than paying out their shareholders. So their theory is, the people that don't pay dividends, is that we could use this extra cash, instead of giving it to our shareholders to make them happy, we could continue growing our company to make our shareholders happy. So that's the theory to not paying dividends. So the companies that pay zero, they're typically, as I said before, they're like startups, or they're also, just newer companies, tech, and, some commodity companies, but I know a lot of them actually do pay dividends. Now, I don't know if you remember this. If you've watched my How to Invest in the Stock Market for Beginners video, these kind of look pretty similar to the companies I say to avoid. So I say to avoid tech, speculation, and commodities, and this is pretty much what this is. So tech, speculation is startups and new companies, and commodities, it's on there. So typically the things that I say don't invest in are non-dividend paying companies. So that's kind of funny. I didn't even realize that till actually doing this right now. So now we're going to get into the dividend paying companies, and whether you should invest in them or not. So you have companies that do a 1 to 2%. 1 to 2, we'll take it 1 to 2. 1 to 2% dividends. These are typically old tech companies. Old tech. And this is also just, a lot of general companies. A lot of companies pay 1 to 2% dividends because it's not that hard to pay 1 to 2% dividends if you are a profitable company. It is a little bit difficult, but it's not, the worst. So old tech, so 1 to 2% dividend companies, they're like Apple and Microsoft. Tech companies have been around for 40, 50 years, in a sense, where they're profitable enough now, have enough cash in the bank where they can start paying dividends to the shareholders to make them happy. Now, Apple didn't always pay a dividend, I don't think, and neither did Microsoft. But have you noticed how I've talked about these companies, how they have stopped their innovation lately? Microsoft has been a little bit better, but Apple kind of stopped innovating since the past 10 years or so. So have a lot of companies. It's fair. It happens. But right when that innovation stopped, Apple started paying dividends. That's because they stopped investing in their research and development as much because they don't have any new ideas what to do, so they started paying out their shareholders to keep them happy, just in case Apple doesn't grow as fast as it normally does. So that's part of the reasoning. There's tons of more reasons why Apple started paying dividends, but that's one of the explanations. They have so much money coming in that they actually don't know what to do with it, and they don't have enough research and development to actually have enough ideas to actually push the money out to the next product. So these companies pay 1 to 2% dividends, meaning that they would, for every $100 you invest, you would get $1 to $2 a year in your cash account, just deposited right in there, done for you. Now, dividends are also paid out quarterly. Sometimes they could do biannually as well. So sometimes, if you have a 1% dividend, instead of getting that $1 at the end of every year, end of every year, you would get it every quarter. You get 25 cents every quarter. So it still equates to 1%, the difference being that you get 25 cents per quarter versus $1 one time. So you get 25 cents 4 times versus $1 once. That clears that up. Okay, so let's move on to the next level of dividends. Okay, so we're moving on to the mid-range ones. All right, and this is the zone. This is my favorite type of company to invest in. All right, even though I do some 1 to 2% companies, some older, more stable tech companies, I like the 3 to 4. I'll even go 5%. Occasionally, 5%ers can be good. So these companies that do a 3, 4, 5% dividend, they are typically financial companies. So finance, telecom, utilities. There's a bunch of different companies that do these kinds of dividends, the 3 to 5%. But they're typically like energy, telecom, finance, banking, those kinds of companies. So these are the 3 to 4 to 5% dividend. Means that, well, if you invest $100, you would get back, 4%, so that would be $4 a year for every $100 you invest in cash in your account. So that's pretty good, meaning that you're almost guaranteed to get a 4% return per year. So here's why I don't say it's guaranteed. 2 reasons. One of which is the stock value could decrease by the time the dividend's paid out. So let's say you invested $100 and it drops down to $90 by the time the dividend's getting paid. You would, instead of getting $4, you might get $3.80 or something, whatever that number is. So, and the other reason is that, well, dividend percentages are not guaranteed. And so this is the most important thing when talking about high dividend stocks. All right, let's go up to the next number here. I'll get to this. So 6% plus. So typically when a company pays a 6+% dividend, I always say do your due diligence, because for a few reasons. It's usually 1 or 2 reasons that a company has that high of a dividend payout. One of which is the company is going through a negative either PR battle or sort of a downturn, and they're looking to pay out more of a dividend to make the stock more attractive to invest in. So they want their stock value to go up again. There's lots of reasons for that, so that they can get loans. There's a lot of reasons why they want their stock value to go up. And they're willing to pay you cash to increase the demand of the stock. And that might only happen once or temporarily. So a company could go from paying a 1% dividend, the stock goes down, people for whatever reason have a negative opinion of this company. So the company decides, let's pay out a 6% dividend. And that makes a lot of investors try to come in, make the stock more attractive. Hey, if they pay out 6% dividends for a whole year, we can make a lot of money. So the demand for the stock increases, stock price goes up. The company can then use that additional valuation to their company to potentially get loans and expand. There's lots of things they could do. But they have to burn cash to do it. So that's number one. And that's really the biggest reason why actually there's high dividend paying stocks is to pump up their stock price. Another reason is that, well, maybe the company is paying out their normal dividend. So let's just say a company normally pays out a $3, so we'll just say a 3% dividend, and has a flat cash payout every single year. All right, relatively, adjusting for inflation. Sometimes the stock value might plummet 20, 30%, and so that dividend that was maybe at 3 or 4% all of a sudden is up at 5 or 6%. It's because the dividend's the exact same. It's the exact same dollar amount. However, because the stock price went down, the cash payout stayed the same. So cash payout, stock value, and then the ratio of these is the dividend percentage. So if the stock value goes down, the dividend percentage increases even though the amount you get from the dividend stays the same. So that's kind of a basics of dividends here, but 6%, this is high risk, all right? So these are companies typically that are looking to up their stock value for a bunch of reasons, as I mentioned already. So I've seen like mining companies or like raw material companies. I've seen companies just with bad PR. Some energy companies too. Some new company, like there's some older companies too, looking to get better PR. There's lots of reasons. But typically, if you're paying beyond a 6% dividend, because think about this. The company has to pay everyone cash, okay? So Apple, they're paying 1% of their company value, of their stock value, in cash back to their investors every year. A 6% yield is 6 times greater than what Apple pays out to their shareholders, and Apple prints money. So if you have a company that's paying out 6% in cash, that's a ton of money coming from their bank. So I always say there must be a reason why they're doing that. Now, there are some stable companies out there that kind of float close to 6% dividend yields. Like I've seen AT&T and some telecom companies float up towards 6, like 5.5 to almost 6%. Those can be safer investments, but I always just say, as soon as something hits even 5% or above, you start to question, okay, why is this yield 5%? Why are they paying their investors so much? There has to be something wrong with this company. That's what I start thinking. Now, sometimes there isn't, sometimes there is. But again, when you start seeing something like 7, 10% yields, those are not sustainable. So not sustainable. Don't know if that fits on camera here, and it's also ugly writing. Sustainable. So if you see any yield above 6, 7, 8%, that's a one-time payout. A company cannot sustain itself, for the most part, paying out 10% of their whole company's value in cash per year. That's insane. Imagine paying a 10% royalty. Like you go on, watch the show Shark Tank, okay? A lot of you watch it. Kevin O'Leary, and you know, a lot of those sharks make royalty deals. You know, some will do 1, 2, 3%, and once they get above 3%, you hear all the sharks saying, that's going to stunt your growth, or the entrepreneur says, that's going to stunt our growth, we can't do that deal. And that's like 3%, in some cases 4, 5, 6%. Imagine 10. That's kind of what this is. It's not the exact same, all right? It's not the exact same. I don't want to, because royalties are sales, and this is tied to share company value. So I don't want to tie those together, but it is a little bit similar. All right, so imagine having to pay out 10% of your company's value every single year. That's just not sustainable. So here's what I say about high dividend paying stocks, is that usually the companies that pay between 1 and 5%, usually okay, 1 to 4%, those are usually sustainable dividends. Oh, here's the other thing too. Before you buy a dividend stock, regardless of what it is, check to make sure that they have a history of actually paying out the same rate of dividends or an increased rate. So, as I mentioned already, a company doesn't have to pay 3% dividend every single year. They don't have to. Some companies do 3% for one quarter, 2% for the next quarter, 3% for the next, 1% for the next. Some companies will change their dividends every quarter. So you're going to want to do research. Now, there's a lot of consistent companies out there, like Coca-Cola has been paying out the same dividend for like essentially 40 years, if not more. Since I've invested in them the past decade or so, their dividends really rarely changed. So there's a lot of companies out there with a good track record for paying you cash dividends. And you can, this could be a whole nother video, is that once you get that dividend, it's up to you what you do with it. You can cash out, go buy, the fancy whatever clothing you want, go buy a purse, whatever you want to go buy. All right? Go buy, a new game, whatever you want to go buy, go for it. But, you know, compound interest is a hell of a drug. If you were to reinvest that money that you get from the dividends, in the long term, it's going to accelerate your growth to the point where if you invest $10,000 at age 20-something, 25, even 30 years old, and you don't really add too much to that except for the 4 to 8% gains you get every single year, let's just say the 4% dividend, you might retire with a couple $100,000 just from that $10,000 investment. And that's maybe $100,000 probably over a few decades. I don't know what the math on that is. I don't know what the exact math on that is like. But again, that's something to think about too. So once you get your dividend, probably buy or invest in something else. Try to invest in some other stock that will accelerate your growth over time, and try to not take that cash as like, hey, I get to, you know, dinner's on me tonight. Don't do that. All right, reinvest it if you can, and reinvest it in a smart way. And I have tons more videos on this, like compound interest and stuff, so please check those out. And I have lots more dividend ones. I have a whole playlist for the stock market videos, so go check those out in the link below. And I think I'll just see you guys in the next video. And subscribe, please, because I want the subscribers, and I love all of you. You are all very beautiful people. And I'll see you guys in the next video.